Things to consider when trading Forex. It is not true that to invest in Forex you have to have a lot of money. It is true that with equal choices, a successful trade makes it proportionate to the money invested. The really important thing is that with whatever sum you start, the currency exchange can give you earning opportunities. It all depends on how you invest. It is not an easy thing as long as it is said, and it takes time and attention. There is only one way to earn from the Forex market. Sell your currencies at a higher price than the one you bought them. In short, to trade in currencies and get a profit, one must know how to choose. Here are 7 things to keep in mind. 1. Plan your trade. The first advice that we can give you about financial investments is about the planning of investments, or understanding what are the best actions to buy and diversify your portfolio. Even if you have never experienced this chain of events firsthand, it is not a problem. Sooner or later, you have to learn. In order to better diversify your currency portfolio and understand where to invest, we recommend opening a demo account. The demo account allows you to not only plan investments, but also to carefully analyze the currency pair in which you want to invest, plan your investment strategies, familiarize yourself with the platform, get familiar with the market. If you decide to buy currencies unconsciously and then open a real account and invest without the right measure, then prepare to say goodbye to your immense capital. Of course, this is not the most appropriate and wise way to invest. 2. Draw the investment plan you just made. To quote W. Edwards Deming, a world-renowned essayist and quality management consultant, "If you cannot describe the process of what you're doing, you do not know what you're doing." As for everything that requires a certain discipline, it is important to outline its trading strategy. In this way, it will be easier to articulate it. Once your strategy is written, look at it to make sure it meets your long-term investment goals. Writing and schematizing your strategy will give you a firm base to start again in times of chaos, and will make you avoid making important trading decisions dictated by emotionality. It offers you a clear outline to review and change if, with time and experience, you will notice defects or if you change your investment goals. If you are a professional trader, having a written strategy in black and white will help you better understand the investment process. 3. Learn the difference between investing and speculating. Understand the difference between a trader and a speculator. Understanding the difference between a trader and a speculator is very important. You need to know how to use the difference if you want to make the most out of your investments. Before buying currencies, you have to evaluate, what do you want to get from the markets? What is your personal level of risk tolerance if you are investing? If your goal is to speculate on the markets, the time you have available to spend on investments. If you want to get the maximum profit in a tight time, then you must have a considerable minimum time to devote to the study of markets and financial instruments. So you must understand the difference between speculator and investor. What does a speculator do? The speculator is that trader who buys and sells shares to make a profit in the short term. In this case, we are talking about very narrow trade times, ranging from a few minutes to a few weeks. We do not talk about years or months. They only take advantage of the price difference between the value of the sale and purchase of the deal. The speculator's characteristic is that it is not interested in dividends distributed by listed companies. What does an investor do? Contrary to the previous one, the investor, also defined as a long-term investor, invests his capital by providing liquidity to the currency pair. In this case, the trader will buy the so-called lots of a given currency. What is the goal of a trader? Keep the currency in his wallet for a longer period of time and make them profit. Very important in this case is to understand what kind of player you are. Pay close attention to this step as it is essential in making money in the Forex market. Most of the traders' operating strategies are based on fundamental analysis that is very different from those of a short-term gambler or speculator. Understand the importance of timing and the impossibility of getting it right. Very important is to understand when is the right time to buy and sell currencies. In this case, the timing is an indispensable part to identify the currency pairs to be bought. If the correct price levels are not identified, there could very well be the risk of entering the market at a risky point. This could be unfavorable and does not allow us to accurately quantify the transaction's risk-return ratio. 5. Learn your strengths and weaknesses. Does your investment strategy follow your idea of how investments depreciate or appreciate? If so, how do you exploit your knowledge? This question refers to your actual knowledge of the market. Ask yourself, what makes me smarter than the market? What is my competitive advantage? You may have a special knowledge of the industry or have access to a study that few others know. Or you could get your own opinion by exploiting some market anomalies, as happens in the strategies for the purchase of securities with a low price-value ratio. Once you have decided what your competitive advantage is, you need to decide how you can use it profitably to develop a trading plan. Your investment plan should include rules for both purchase orders and sales orders. Also, keep in mind that competitive advantage could lose its profitability and its effectiveness if other investors will begin to adopt your own investment strategies. Or you can be convinced that markets are totally efficient, which means that no investor will ever have a real competitive advantage. In this case, it is better to focus on minimizing commissions and transaction costs by investing in passive instruments such as futures. 6. Is your strategy versatile? There is an old way of saying on Wall Street, the market can remain irrational longer than you can remain solvent. Successful investors know where their investment performance comes from and are able to explain the strengths and weaknesses of their strategy. As trends and economic issues change, many investment strategies have periods of great performance followed by periods of poor performance. Having a good understanding of the weakness of your investment strategy is essential for maintaining confidence in the market and investing with conviction, even if the strategy has been, for the time being, out of fashion. Understand that a good strategy can be measured. It is difficult to improve or fully understand something that cannot be measured. For this reason, you should always have a benchmark to measure the effectiveness of the investment strategy you are using. This benchmark must be consistent with investment objectives, which in turn must tune into your strategy. There are two types: the relative benchmark and the absolute benchmark. An example of a relative benchmark could be the EUR-USD pair. An example of an absolute benchmark could be a performance target. Even if it is a time-consuming process, it is important to consider the amount of risk you are taking with respect to the investment benchmark. This can be done by recording the volatility of portfolio returns and comparing it with the volatility of benchmark returns over certain time periods. The Forex broker. The Forex broker is the entity that connects the trader to the market. The broker gives you the chance to open an account, and this account is the one that you use to purchase currency pairs and hold them. The broker makes all this possible for you. Before the advent of brokers, you had to invest a huge amount of money and create a special relationship with banks just to buy the currency. The broker makes money by charging a commission when you make a trade. The change in the relationship when you trade a currency pair is called a pip. The broker charges you several pips before you trade. So, whether you win or lose a trade, you have to pay a small amount of money to the broker. The major task of a Forex broker is to give you easy access to the Forex trade market while he makes money. You will come across many Forex brokers out there, some small, some big, but all of them work in the same fashion. These brokers are regulated by bodies that are put in place by the different economies across the world. Reasons why you need a Forex broker. So why do you need a Forex broker in the first place? Here are the reasons. 1. Gives you access to trading platforms. The broker gives you unlimited access to reliable and legitimate trading platforms. Remember that the wrong platform makes it hard for you to make money in Forex, which is why it is vital that you work with the right broker to do this. The wrong trading platform also eliminates the element of time wastage. This is why it is vital that you work with the right broker for this task. The right platform gives you all the access you need as well as tools to achieve the trades that you need. To connect to the market, you need to make sure you work with a reputable broker. Some are scammers, and you need to watch out for this. We shall cover the trading platform later. As for now, we focus on the broker. 2. Allows you to take advantage of leverage. Leverage is the act of borrowing funds to place your trades. This makes it possible for newbies that don't have enough funds to place huge orders. The right platform gives you a high ratio of leverage to use to supplement your capital. As much as leverage is good for you, it can also work against you, especially when the market is moving in the opposite direction than what you predicted. When this happens, you stand to lose a lot of money. 3. Offer various tips. A good Forex broker will give you tips and knowledgeable articles so that you can gain the necessary skills to succeed. Some of the skills include helping you to access the tutorial that allows you to understand what is happening in the other markets. They also give you guides on how to trade successfully. The right broker includes demo accounts on the platform. These accounts give you a simulation environment that gives the beginner a chance to know what it is like to trade live. The demo account also assists the seasoned trader to test out the various strategies before they start trading live. The broker can also include posts in their blog that can point out some techniques that the beginner can use to advance. They also use blogs to give an insight into new concepts on the market. Other brokers offer Forex tutorials, which are both free and paid. Make sure you understand this concept and what you need to learn. 4. Give you low fees. The right Forex broker will not take a lot of your money. Instead, they take a small percentage that is nearly insignificant. 5. Protect your interest. Reliable Forex brokers are under the regulation and rules of many institutions. These institutions help to manage the brokers as well as regulate the components of the market. Depending on the region, the Forex brokers are bound by rules that the institutions put in place. The rules are meant to protect your interests in the market. These rules make sure that you have a reliable and transparent relationship with the broker. When picking the right broker, you must pick one that is regulated by a known financial institution so that you can protect your interest. Brokers who aren't regulated tend to carry more risk compared to those that aren't regulated. Choosing the right broker. Choosing the right Forex broker is a huge task because all that you do in Forex trading depends on the broker. Here are a few aspects to look at when making the perfect choice. 1. The security. A good broker needs to provide you with a high level of security at all times. Remember, you are going to invest thousands of dollars in the system, and this means that the money you invest is transferred to an account that has been set up by the broker. You don't want to place all your savings in the hands of someone that isn't legit, do you? The good thing is that you can easily check the credibility of a broker easily. All you need to do is to contact a regulatory body that will give you information on the broker. Each country has a regulatory body that is capable of giving you this information. Before you put your money in the hands of the broker, make sure he is a member of the relevant regulatory body. When you go into Forex trading, the main aim is to make a profit. You make a profit by deducting the various expenses from the selling price. Remember that the more the expense, the lower the profit from the trade. When trading in Forex, regardless of the currency pair that you trade in, you will be faced with costs. Every time you place a trade, you have to pay a commission or a spread that goes to the broker. This is why it is just natural that you go with a broker that gives you the cheapest rates. At times, you might decide to go with a broker that charges more just because he is reliable. Remember, it is all about making the balance between the security and low costs of the transaction. Using a broker that offers competitive spreads helps your bottom line greatly. And you don't want to sacrifice joining a broker that has poor execution just for the low costs. When you choose a broker, you go up against different types of commission structures. Fixed spread. This is a certain percentage of the actual price. They don't charge you a commission when you trade. Rather, you pay a certain amount of pips that is charged on the price of the trade. Variable spread. This type of broker marks up the price of the trade, but the markup is determined by the market condition. This means that the amount you end up paying is variable and not fixed. High liquid times come with narrow spreads, while low liquid times come with a higher spread. Just like fixed spread brokers, variable spread brokers don't charge you a commission. Commission only. Here you won't pay a markup on the trade, but you pay a commission as per each lot. 3. Easy deposit and withdrawal. Reliable brokers allow you to deposit the funds, then withdraw them when you feel like, without having to go through many processes. Once you make your choice, the broker shouldn't make it hard for you to withdraw the profit, citing some irrelevant reasons. The withdrawal process needs to be fast and efficient. Some brokers force you to add money to the account before you can withdraw your proceeds, which shouldn't be the case at all. 4. Offer the right trading platform. Remember that all the activities that you undertake happen on the trading platform that the broker gives you. This means that if the platform doesn't work out for you, even if you have the right strategy, you end up losing out. This is why you must choose the right platform to make things work out. When choosing the right broker, make sure he has the perfect platform that you can use. We shall look at the different platforms later, but at the moment, remember that the platform has a lot to contribute to the final results. 5. Customer service. There is no perfect broker on the market. It is all about giving you a service that makes sure you enjoy trading. There are times when the platform might fail, and when this happens, you need to have direct contact with the representatives at all times. 6. Currency pairs offered. There are many currency pairs that you can trade in, but only a few get the attention that they deserve. When you choose a broker, make sure he provides the currency pairs that you are interested in. 7. Financial stability. The security and the financial stability of the broker need to give you the peace of mind you need to run trades successfully. When researching the broker, you must understand how strong the brokerage is. Some are small while others are big. You will find this information from the regulatory body or the website of the broker. Remember that the safety of the account should be the primary concern, and trading with a capable broker goes a long way in making sure you safeguard the account. 8. Reputation. When you talk to a few established traders, you will realize that they usually recommend a few reputable brokers that you need to work with. This means that you have to go with a broker that has been on the market and has built a reputation for good trading. You will notice a few new brokers that spring up each year, so you need to be careful when choosing the broker so that you don't turn out to be the guinea pig for the brokers. These brokers also come with different ratings, with some having a high rating while others have a low one. So now that you know that the rating is vital, how do you go about determining how the rating? First, the regulation is a plus for any broker. As long as the broker is regulated, it means that they are highly rated in the Forex trading realms. You need to read about broker reviews so that you see what past and present customers are saying about the broker in question. Another indication of the rating is the actual age of the company. How long has the broker been in the market? Brokers that have been on the market for more than 7 years deserve your business because it shows that they have mastered the art. Features of a good trading platform. Back in the 1990s, when traders realized how important trading platforms were to Forex trading, only a few companies had the tools to make them succeed in their trades. Since this time, companies have been working tirelessly to make sure that as a trader, you have the best access to platforms. Currently, the most successful platforms come with a host of tools and features that make the tools easy to use. One of the reasons why Forex trading is becoming popular is because of the high rate of growth of the industry, coupled with the limitless opportunities on the market. As a result, an unlimited number of traders have taken up the market and are now making sure that Forex trading becomes better and bigger. Modern Forex trading relies a lot on using software and tools, which help to reduce the complicated trade activities into simple affairs. However, when choosing the right trading platform, you need to pay attention to various aspects that make these platforms ideal for the trade. Simple to use. The right platform should be simple to use. It needs to be simple enough for you as a new trader and advanced enough for seasoned users. This means the platform should have the tools that make it easy for you to navigate and access all the vital actions that help you trade successfully. Should give real-time information. The financial market is volatile and unpredictable. This means that you need to expect sudden changes in the direction. Due to this, the platform that you choose needs to have an option that gives you real-time data and prices. To achieve maximum efficiency, the updates and changes need to come in real time and fast, so that you make wise and timely decisions. Not only this, but you need access to the information fast and in an easy manner. The platform should give you access to hourly, daily, and weekly reports at a convenient location. Easy to customize. The platform you choose needs to give you various customizing options, so that it gives you all the functionality you need. The functionality should meet your specific needs and requirements as a trader. To keep up with the latest technological advancements, the platform needs to give you access to the latest technologies in the market. The broker needs to be privy of the technological advancements in Forex trading and incorporate them into the platform all the time. This enhances the efficiency, mobility, and accuracy of the system. Additionally, it makes it convenient for the user to be able to safely log into the system. Charting software. Remember that you make your decisions based on charts that you interpret. You, therefore, need to choose a platform that gives you access to charts of all types. Risk management. Every business has risks, and this goes for Forex trading as well. You will come across different types of risk, covered in the next section, and you need to make sure you know how to handle them. The platform needs to give you a set of risk management tools that allow you to protect your profits while limiting the losses. Speed and stability. The platform needs to be built on top of a system that is stable and engineered for speed. Remember that the faster you execute your orders, the higher the probability of profitability. When the system is slow, you might end up losing on profitable trades just because the rate of reaction is slow. In a normal market condition, when you hit the button to either buy or sell, you expect a speedy trade at a specific price. As a trader, you need to make sure the execution on the platform is fast and not full of errors. The order needs to be filled in seconds and not even minutes. The speed might vary depending on the condition of the market. For instance, the speed of execution is slow during high volatility, but you need to understand because such situations are out of control of the broker. When the market is normal, you need to ask for the proper execution of trades from your broker. You can understand the speed of the platform during the demo phase. Account types. You need to choose a broker that gives you various account types to choose from. Each account comes with various features, which you need to understand so that you align the account with your strategy. Demo account. This refers to an account that simulates the live account. The account is usually loaded with virtual funds to allow you to practice trading. The practice account is ideal for rookies that are looking for a platform to try out their skills as they learn the ropes. It is also ideal for seasoned traders who are looking for a platform to practice new strategies. Live micro account. This is the smallest account that you can start with. It allows you to trade in micro increments and is ideal for rookies. Live mini account. This has become a popular account for many traders, especially novices. The increments are bigger than the ones in the live micro account. Live standard lot. This is ideal for traders who have a bigger account size. These come with better commissions and give you access to premium features that you can use to trade. As you can see, the different accounts require you to have a certain level of funding capability as well as experience. As such, you must analyze your situation and choose what type of account is suited for you. Promotions and bonuses. As the years progress, the competition for your business from many brokers has grown, and at the moment, you can have over 100 brokers to choose from. Due to this, more and more brokers are offering incentives and bonuses when you sign up. Each broker gives you unique bonuses, which makes it good for you to check out the various categories of the bonuses before you take a step. Here are some of the most common types of bonuses that you can come across. Deposit bonus. A huge percentage of the brokers offer this deposit. It is ideal for new clients that deposit funds with a broker for the first time. No deposit bonus. This bonus is made when you start trading. It might come after you reach a certain point in the trade, say 10 trades. Forex rebates. Under this, you get a rebate when you place certain types of trades. It makes more sense for seasoned traders than new traders. Data security. One of the security issues that are being grappled with in the real world today is identity theft. Many people have lost their funds when their credit card information has been stolen online. When you open an account, especially online, you need to be sure that the information is in safe hands. Some of the information you will submit online includes your credit card information, passport, and much other sensitive information that shouldn't fall in bad hands. It is vital that the broker's website is secure and uses encryption to make sure your data is always secure. Automation of the trading. Many traders don't have time to sit on the computer and run the trades manually. When you have the time, you can do this, but if you have limited time on your hands, you must choose a broker that allows you to automate most of the tasks. A major benefit of this program is that you can step away from the system and let the trade get executed on your behalf. It also eliminates the emotions that are a part of trading, making you benefit from the trades better than the way you trade when you are full of emotions. When you decide to go this route, make sure the broker gives you the necessary infrastructure to achieve the automation. Mobile trading. The mobile age has made trading and other tasks easier because now you can do it without having to carry your laptop along. The good news is that you can access mobile trading platforms from most of your brokers. These brokers offer apps that you can use to trade directly using your smartphone. This makes everything convenient and you can trade while on the go. Typically, you get to access the various functions of the platform from your mobile platform. You get to open and close positions, manage any open positions, and set stop limit orders as well as monitor charts. The only difference is that the interface might be smaller than when you do it on the computer. Managed accounts. For those traders that don't have time to place and monitor trades on their own, then the concept of managed trades is ideal. Such types of traders don't have the time to learn the ropes, and therefore opt to entrust the entire operation to the broker. When you decide to go this route, you need to open a managed account with the broker so that he manages everything on your behalf. With the account, you maintain proper control over the whole process, but you give the manager the capacity to trade on your behalf. The whole process depends on an agreement that you sign with the manager. However, you need to have a huge capital base, usually of $20,000 or more. Payment options. Before you can start trading, you will have to deposit some money with the Forex broker. The broker needs to provide you with various methods of depositing money into the account so that you can place trades. There are many ways to deposit the money into the account, including credit cards, payment processors, and wire transfer. Whatever the method, you need to understand that for the trade to work, you need to choose the best method to use that is suitable for you. You shouldn't just assume that the broker has the method you desire without checking out their facts. Additionally, the broker will give you a limit as to the amount you can deposit using each method he has placed down. For example, a broker might allow you to deposit a maximum of $400 using PayPal, but allow you to deposit more than $2,000 with a credit card. You should look at each method and the maximum level you can deposit. Additionally, there are various regulations within countries that determine how much you can deposit and withdraw. While some brokers allow certain methods to use for depositing, they don't allow you to withdraw using other methods. Tools. As a rookie in the market, you need to access resources that can help you run the trades. You need to have access to webinars, books, and videos that guide you on how to use the platform. Others teach you about technical analysis as well as calculators. Most of the tools are free of charge and they assist you in making valuable decisions. Knowing what type of information you need from the broker helps you choose what type of broker you need. Other fees. When choosing the broker, you need to look at the various fees that the broker comes up with. Some will charge deposit and withdrawal fees, wire fees, as well as account transfer fees. Make sure you are aware of these fees before you join a platform. What is technical analysis? The first strategy that we looked at when it comes to Forex trading is fundamental analysis. For many traders, that is the preferred method to go with. Fundamental analysis allows them to look at the currency as well as the country, economy, and government behind that currency to determine if it is time to invest in a currency pair or not. It can work really well for a lot of traders. But another strategy that you may want to consider includes technical analysis of the currency. Technical analysis is all about looking at what has occurred with the currency in the past. You may look over the past week or look at a decade or more. This kind of analysis will have you take a look at a lot of different charts and graphs, and you may even have to look at some older newspaper articles and magazines to figure out why certain ups and downs occurred in the charts. The point of doing all this is to get a good idea of all the trends and overall movements that occur within that currency. While this can work for a country that happens to stay pretty steady, there can be some issues that make it harder to work with this kind of analysis in the Forex market. For example, this kind of analysis is not able to make predictions about massive disasters or times of uncertainty in the market. Simply because a country hasn't experienced these in the past doesn't mean they won't work in the future. Most traders who use technical analysis will combine it with some of the other fundamentals that we discussed to strengthen their knowledge and ensure that they can see things from more than one angle. Of course, technical analysis is done mostly from charts. You can see if your broker offers these as part of a package on their platform. And then you combine these with other research, such as checking the news and other fundamentals to make the best decisions. The charts that you will use are known as price charts, and their job is to show you the exchange rate of a currency over time. And depending on the time frame that you want to look at, it is possible that you will see a lot of information on that chart. For example, if you pick out a chart that spans a decade, the chart is probably going to look more like a flat line over time. But if you zoom in on the chart a bit more and look at just 1 year, you will see that there is a lot more movement up and down. The time frame that you rely on is going to be really important. This is because a Forex trader has to really consider the time frame that they want to trade with. You want to look at a few things, such as the best time to make a move when a trend starts moving. To do that, you must look through some daily charts and make predictions about whether the trend you see will continue or reverse in the next few hours. As a beginner, you will spend a lot of your time looking at the simple moving average. This average is going to calculate from a set of price points by adding them together and then dividing the outcome by the number of points that you choose. If you do go with this one, it is best to go with about 20 points for the most accuracy. As you progress, you may find that the weighted moving average is better for you because it is going to give some more weight to recent trades that have been able to impact the trend. So, what information are you going to look for to be able to get out of these charts? First, you will look for support and resistance. Throughout the day, it is pretty normal for a currency pair to bounce a bit, going between a high and low level. The lower part is the support, and the higher point is the resistance. This is going to happen because traders are working to buy and then sell currency to take advantage of some of the pip changes that will occur. When a particular currency pair hits one of the supports, you can buy into it. Then wait until it gets back to or close to the resistance before selling. To make sure that you are effective with doing this, you will want to make sure that there are some protection orders to help you get out of the market if there are any unexpected changes. This method can be nice because it is effective. Many other traders are doing the same thing. They all buy in at the same time, which causes the value of the currency to go up. And then they will sell at the same time because they see that the currency value is getting back to the resistance level. This will cause the value to go back down. It is a trend that keeps on happening because so many people enter the market and try to use this plan. This doesn't make it a bad option. It basically just shows that it can be an effective one for you to try out. Just make sure that you are certain of the support and resistance levels along the way. And don't think that you have to get it at the exact support and exact resistance level. Hitting that exact point is pretty much impossible. Just try to get as close as possible, and you will be able to make some good income from this kind of investment. Another trend that you can look at is the breakout trend. These are the trends that will break out of the resistance and support curve, and often they will show up after a new event or a piece of news is released. This is where you will want to bring in your knowledge of the economy so that you can determine when a breakout is going to occur. If you guess correctly, you can get into the market before the price goes up and sell when it reaches its top. Or you can get out of the market in time if the news is bad or brings up uncertainty before the market crashes and you lose out on all your money. Many traders find that working with technical analysis can be a great option to help them earn a good amount of money in the Forex market. It does require looking at a lot of charts and graphs to see success, but for those who can learn about the trends that occur with a specific currency and who are willing to watch out for some big news items that may change the course of their currency pair away from its historical values, then technical analysis may be the right option for you. Great strategies for first-time traders in Forex. The plan that you decide to go with is going to be completely personal. You need to decide which currencies you like to work with, how much risk you are willing to take, and how much time you have to devote to this process. But as a beginner, there are some strategies that you can work with that can help you get used to the Forex market and can make your understanding of individual trades grow. As time goes on, you will start to experiment on the things you have learned, and you can adapt your decisions to what you know now. For now, we are going to take a look at some of the different trading strategies that you can try out to help you get started. The first strategy that you can try out as a beginner to make the trading easier includes 1. Start out with a limit order. The reason you want to do this is to ensure that you will purchase a set price and you don't focus on the market price. The market price will often move up and down while the order is active, so it is better to work on the set price to keep things easier. 2. Decide the possible gain that you want to get based on the pips. 3. Decide what you would like the stop loss to be at to protect your risk. 4. Exit the position right when you start to gain the profit that you aimed for, or when you hit the stop loss point that you decided on earlier. Never fall prey to the temptation to stick around and see if it is possible to make more if a currency pair bounces back. This gets you into a bad habit of sticking around for too long, and you can end up losing too much money in the process. Now that we have a basic trading schedule down, it is time to take a look at some methods you can go on that will help you reduce your risks while also helping you make a profit. This time, this is not so much a step-by-step guide like before, but more of 3 choices that you can make when you set up a new trade. You can either use them individually on their own or in a combination together to get even better results. The 3 choices that you can make for your trades include: 1. A stop-loss order. This is when you will decide what you will do if the worst-case scenario occurs. It is either the low or the high where you will reach a loss, and it is going to represent the maximum amount of money or capital that you are willing to take on a trade. 2. A trailing stop-loss. This is often a better choice for a beginner to go with. This is because it will follow the price and then will represent a certain number of pips off that current price. If the market does end up turning, this option allows the position to close. But if it continues on the trend of going up, you can continue to make a profit until you reach your closing order later on. 3. A take profit. This is an order that will remove the profit that you gain during a trade while continuing with your position. The next thing that we're going to take a look at is a good trading strategy that you might like when you want to work with analysis before making any trading decisions. Some of the steps that you will do to help you with technical and fundamental analysis at the same time include: look at how the economic situation is doing throughout the world. You may look at some of the major players in the market, but you want to first get an overview of how the economy is doing for everyone. Now it is time to narrow your scope to the specific currency pair that you would like to trade in. You can look for information sometimes through news items or a report that will pertain to your chosen currency pair. Any news that will affect the movement of your pair is something that you should pay attention to. Look at some graphs to help you figure out what the resistance and the support for that currency pair will be at. In addition to coming up with where the resistance and support are for that pair, you should also look at whether there are any indicators for breakouts occurring. If you can look at a currency pair and find 3 different indicators that suggest that it is time to trade at a specific currency, then you know it is a safe and profitable one to go with. Once you find this, then it is time to set up the order. The next plan that we will look at is an overall plan that can help a new trader go through all of their charts or all of the charts that you can get a hold of, and how to use the simple movement of resistance and support to your advantage. Some of the steps that you can take to utilize all those charts, starting when you sit down at your computer to the end of the trade, will include the following. 1. Take a close look at the index of the currency. You can use it to identify a currency pair that is showing good movement. If a currency pair is showing some good movement, it is worth your time to invest in it. 2. Look at the charts for the pair that you want to trade in, making sure that the charts look at different time frames. Consider looking over the current week, 1 month, 3 months, 6 months, and a year. You want to take special care to look for any patterns that occur across these time frames, especially the ones that might have some impact on what is happening to the currency pair right now. 3. Look at the daily chart to help you get a good idea of whether you should sell or buy a currency. Move down to the 4-hour chart and check to see whether the indicators stay the same. 4. Then move to the hourly chart. This is the chart that you need to look at to find the resistance and support. If you can find these lines, then pay attention to all the intervals of 10 minutes to see if these lines change at all. 5. Once you know the best interval for buy or sell because you see that the resistance and support levels are hit, then it is time to make your position. 6. Set the positions and orders. You can exit out of your position when the movement has traveled down in the opposite direction. When the trade enters the support when you start with the resistance, or the resistance if you start with the support, it is time to end the trade. 7. You can then repeat this with the next interval. When you continue to do this, you will find yourself hitting the pip target regularly, and it won't seem too hard either. Now we are going to move on to the last strategy for the Forex market. This one is going to allow the beginner to make broad use of all the available information that is there for you. The steps that you need to take to make this one happen for your trade include: 1. Choose the currency pairs that you want to work with according to several factors, like which window of time you wish to trade in, which ones have the most risks, and which will show the best movement at the time. 2. Look at your chosen sources for your fundamental analysis. You will want to use this to help you get a clear picture of what is going on in the countries of those currency pairs, and how that may affect the currency while you trade. 3. You can also look for indicators or the strength of a currency. You can always look at whether it is currently being under or overbought. 4. Watch to see if there are any directional changes in the currency. This can sometimes happen when a market first opens because traders may make some changes at that time. 5. Use a potential trend reversal as a basis and then look at both the hour chart and the 15-minute chart to find out more information about this trend and whether it will actually take place. 6. Decide whether you want to trade against or with this new long-term trend. This will depend on where the trend is going and the goals that you have in place. 7. At this point, you will want to take a look at a currency matrix to see how those currencies are actually doing. This will tell you which currency out of the two will drive the movement that you are anticipating, and how much trade is going on at the moment between those currencies. When you figure out which of the two is the most dominant currency, you can look to see how it behaves with other currencies and then use this information to figure out whether the movement is risky or solid. 8. Set your trade up so that it has a stop loss, remembering all of the data that you have already gathered. The more chances there are that a trend will change quickly, the riskier the position can be and the tighter you should set the stop loss position. These are a few of the different strategies that you can use when it comes to working with the Forex market. Each of the trades that you decide to do will need some kind of strategy behind them to ensure that you are making smart decisions and won't be surprised later on because you stayed in the market too long or you went in without any idea of what you were doing. Make sure you follow one of these strategies or use fundamental or technical analysis, or even a combination of the two, to make your trading easier. Thank you. I would like to thank you from the bottom of my heart for coming along with me on this trading journey. There are many audiobooks out there, but you decided to give this one a chance. If you expanded your knowledge by listening to this audiobook, then I need your help. Please take a moment to leave an honest review of this audiobook. This feedback gives me a better understanding of the kinds of audiobooks and topics listeners like yourself want to know more about. It also gives my audiobook more visibility to potential new listeners. Leaving a review takes less than 1 minute and is much appreciated.